Welcome back, everyone. We have a busy one to get into today. The market is on fire, and not in a good way. Not like it's on fire because it's doing so well. No, the market's burning to the ground. Right now, we have the S&P 500 down 600 points. Now, 600 points, if we look at that in terms of percentages, it's down 2.54%. 2.5% with the S&P 500. The Dow Jones is down 1.6%, and the NASDAQ, our favorite QQQ companies, all the growth stocks, those are the ones that are receiving the most pain today, down 4%. That's huge. The NASDAQ dropping 4% in a day, that is an intense sell-off, and it's getting more intense by the minute. In fact, we have a lot of political news playing into the market sell-off. Scott Bessent, the Treasury Secretary, recently said that there needs to be a detox period. A detox period, what does that mean exactly? We also have President Trump changing his tone from the first term to the second. The first one saying that he loves the stock market and loves the market going higher. And this one, he's now saying that he's not still worried about a market sell-off. It's not his primary goal. We're going to be looking at some of this commentary and how it's impacting the markets. And we're going to be looking at individual stocks and how things are trading. There is a trade going on, a rotation. This is normal during periods of sell-offs. Investors flee from one category of stocks and they move that money into another category of stocks. We're going to see what they're fleeing from and what they're moving to. Plus, we also have some early warning signs of a recession. We'll be looking at what I've been seeing in my company's commentaries and earnings calls. And we have a couple other news items like Apple and their struggle with the artificial intelligence boom. They are at a make or break point. And we have two stocks I want to look at in particular. Ones that I'd like to warn about, which are Tesla and Palantir. So this is going to be a very full episode. We have a lot to get into. Let's go ahead and get started. Now, before we jump into the news, we have to talk about what's selling off in the market, the rotation that's happening. Investors are shifting cash from one category in the market to another. And even though the broader indices like the S&P 500 and QQQ, they just bucket everything together and they kind of hide the individual losses in different companies, right now there are certain companies doing much better than others. For example, if we look at Qualtrim here, we have advanced watch lists, and one of them that I created is called the S&P 50. And it's not exactly 50 companies, but what I did here is add most of the largest companies in the S&P 500 to get a good idea of what's going on. For example, if we look over the past 200-day moving average. So this is the simple moving average versus the last 200 days, which gives you an idea of momentum. This is the momentum of these different companies. Now, if we look at the ones that have had the worst momentum over the past 200 days, we have Tesla, Nvidia, we have Merck right here, Microsoft, Thermo Fisher Scientific, Google, Pepsi, Amazon, and ExxonMobil. So these ones are doing the worst over the past 200 days. The ones that are doing the best are Palantir, Robinhood, AbbVie, Visa, McDonald's, and Netflix. That's how things have been trading over a trend, a longer trend of 200 days. If we zoom in just over the past day today, we can see how things have changed. Some of the biggest beneficiaries that are selling off right now were some of the most momentum stocks just 6 months ago. We have Robinhood going down 17% just today. That's just today down 17%. Tesla's down 13.4%. Palantir is currently down 10%. And all three of these stocks have been down over the past month as well. So this isn't the first day of sell-off. These ones are getting liquidated. And we're going to be talking about two of them later today. But these stocks are getting hurt right now. When we go further down the list, we see that Broadcom's down 7%, Apple's down 5.74%, Meta's down 5.5%, even Google's down 5% currently. Then we get into Nvidia, Booking, Microsoft, Eli Lilly, Amazon, and MasterCard. After Visa, we get to McDonald's. McDonald's is flat today. And then after McDonald's, we get into the category of companies that aren't even in the red today. These ones are currently trading up. This is where the rotation's happening. And the stocks that currently money is moving into are Pepsi, ExxonMobil, Merck, AbbVie, Coca-Cola, J&J, CVX, and Procter & Gamble. So we have some pharmaceutical companies and we have consumer defensives. Companies like Pepsi and Coca-Cola are looked at as highly defensive companies, companies that you race to in times of crisis because they have that steady, predictable cash flow, that nice juicy dividend yield. They are the ones that investors are moving to today. The companies investors are moving out of are the more risky ones, and especially the growth ones. Overall, what's happening in the market today is a flight from quality growth stocks into lower quality, lower growth stocks. And in my portfolio, that's not a good day because I invest almost entirely. In fact, almost all my capital is in quality growth stocks. That is the segment of the market that I believe is the best to invest in. And with this rotation happening, it's bringing some pain into the portfolio. Let's go ahead and take a look at it. The portfolio is at $260,000 in gains. This is the passive income account. And just like 6 months ago, we were at $330,000 in gains. You can do the math there, but it's $70,000. We're down around 70 grand over the past few months. Now, some people suggest that I don't show when things don't go poorly. I only show my portfolio when it's rocketing to the moon. Right here, things aren't going well for the portfolio over the past couple of months. It's true that it's held up well in combination with the market, so it's comparatively doing well, but overall, the gains are going away. The portfolio value has dropped from above $825,000 down to $765,000. My portfolio is not immune to sell-offs. So when the market's going down, don't have it in your head that Joseph's portfolio is just immune to it and it's not susceptible to sell-offs. I invest in companies that are very much a part of the market. And when we have sell-offs like this, you can see the impact. Year to date, if I look at my performance, the passive income portfolio is down 5.2%. If we compare that against the S&P 500, the S&P 500 is currently down 4.1%. So year to date, my portfolio has underperformed the S&P 500. It's going down further than the S&P 500. Now, if we look at my other portfolio, the Story Fund, we can bring up the Story Fund here, and the gains currently sit at $89,000. Now, just a couple months ago, they were at around $120,000. So again, this one likewise has come down a lot. That's because this is a highly concentrated portfolio into only a few names, namely Netflix and Amazon, which have both sold off dramatically over the past month. Amazon has been beat up during the sell-off. Google as well, Microsoft as well, and Netflix has come down from above $1,000 to around $800 per share. So all of these stocks are trading down, investors are pulling back, they're taking some gains in them, and they're deploying that money in more conservative options. So when I look at the Story Fund's performance year to date, it is down 8.56%, which obviously is more than the S&P 500, down 4%. But even if we look at the QQQ, the Story Fund is down slightly more than the QQQ year to date. In both cases, my portfolios are underperforming during the benchmarks during a sell-off. But when you broaden it out and you widen the view a little bit, when we zoom out to a year or 2 years or 3 years, they're both beating their benchmarks by a sizable amount. Now, this is a point that I'd like to highlight. Some investors are concerned about preserving gains, market gains, during a downturn. For example, if they see their portfolio going down every day, it becomes very concerning. It sends off these alarms and bells and whistles in your head saying you're doing something wrong, you're losing all your progress, you're losing all your gains, and you should stem the flow. You should prevent it. You should stop it somehow. And that's how you get market commentary of market switches and things flipping and going from one sector to another, a market rotation. That's how you get investors wanting to preserve their capital, by switching their money from high quality growth stocks to slower growing dividend payers. You see this type of thing all the time. And in some cases, it makes sense. For example, if you're a bank and you have people taking their money out of your business and putting it in all the time, you need to have liquidity all the time. You need to have access to that capital all the time. If you don't have ample liquidity, then you're not going to be able to provide investors their money or people their deposits back when they want them back. So for certain institutions, it makes sense to want to preserve the capital every single year. In my case, it doesn't. I don't need this money for my portfolio this year. I'm not taking it out this year. I don't need it next year either. I have no incentive to preserve my capital on a 1 or 2 year basis. My incentive is to have the highest return that I can over the next 20 years. I'm looking down the road 10, 20, 30 years, and I'm optimizing my performance for a 30-year timeline. I'm not optimizing it for a 3-month timeline. I'm not optimizing it to have the max amount of gains or preserve the max amount of capital I can in 2025. And in most cases, I believe it's a mistake to try to radically change your strategy and move from certain sectors to different sectors and try to race around to preserve capital in the name of reducing volatility in your portfolio. In most cases, volatility is a gift to the long-term investor. And this is exactly what Peter Lynch said many decades ago.
I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9.
He was very consistent in his fund losing money during market downturns. Every single time the market went down, the Magellan Fund, which Peter Lynch ran, went down even more. That's the amazing thing. It went down even more than the S&P 500 all 9 times because Peter Lynch didn't care about volatility. He invested in what he considered the best growth stocks in the market, and those were inherently more volatile and tricky than normal stocks. But the gains overall from these companies that grew their earnings on a compounded rate much faster than the average of the market led to Magellan having 33% compounded returns over 13 years. That is an extremely fast rate of return. It's what I consider to be the best streak of returns ever over a 13-year period, especially for a fund manager managing this big of a portfolio. He didn't use any type of complex strategy. He just invested in a lot of companies that grew earnings quickly, and he held on, had a strong stomach during market volatility. So when I look at market volatility and my portfolio is going down, it does not concern me. It would only concern me if I thought it was permanent, if these losses were not just temporary losses, but they were permanent capital impairment, meaning that I bought a company so overvalued that I'm never going to get the value back out of it. Or worse, I bought a company where the fundamentals are deteriorating. Those are concerning scenarios. I've had that before in the past, but I don't feel that way right now. I feel like this is market volatility and market rotation out of growth stocks into defensive stocks. And it's something that I'm just not going to follow. I'm not going to follow this rotation. These are high quality companies. They grow their earnings very quickly. They grow their revenue very consistently. They have very stable moats. They have low amounts of debt. They're going to survive any type of consumer recession that we get into. So when I look at these companies and I consider that they're growing their intrinsic value every single year, it doesn't concern me that investors are selling out of them this year. The valuation may go down, but over time it will fluctuate and eventually it will go back up. We'll go through these different time periods. I view this as very similar to Benjamin Graham's Mr. Market. Every day we have someone coming to our doorstep and knocking on our home door. They offer us a different price to buy our house. Sometimes it's high and it's very tempting to sell shares at those high prices, and sometimes it's low. In fact, it's insultingly low. But you don't have to sell it to him. He shouldn't instruct you on selling it. It shouldn't be something that dictates an action to you. It's just an offer. You can avoid that offer. You can ignore that offer as a lowball. Right now, the market's wanting to sell you some of the best companies in the world for lowball offers. And we can see that across our portfolios. If I look in the tech category, Salesforce, Google, ASML, these are all great companies. Sentiment typically follows price. As the price goes down, investors view these companies as less attractive. They must be lower quality. They're not really good companies because the price is down, and that's how it always goes. When Meta price was down, it was viewed as a low quality company. When Netflix price was way down, it was viewed as a low quality company. Anytime the price goes down, investors view it as a low quality company. Sentiment follows price. In this case, we have some of the best companies in the world, highly scaled software companies, companies that make lithography machines that nobody else can quite copy. We have the highly profitable, growing quickly Google, and all of them, we have the market giving us lowball offers, saying, yeah, you can pick up shares today with very low expectations baked into them. These are the time periods that investors should find more attractive. Time periods where we should look at potentially adding to our positions that we've wanted to own, and we shouldn't have the lower prices every day dictate our sentiment. We shouldn't believe these companies are lower quality just because the price is going down. So for many investors that have a long enough time horizon, this can be viewed as a nice opportunity to finally get into some companies at more attractive future growth expectations. I recently released a reverse discounted cash flow calculator. It helps you make some simple assumptions on the future, and you can see that as the price goes down on high quality stocks, the future expected return goes up. That's the inverse relationship. We should view this as an opportunity, especially if you're young and you're looking to build your portfolio. Now, there's going to be a lot of people that try to time the market during these type of events. Spoiler alert, you can't. Nobody knows where the bottom of the market is. Nobody will be able to definitively say it. The people that have recently predicted this market crash, in many cases, predicted 5 market crashes that didn't happen before this one. The people that predict it's going to go down much further don't know. The people that predict there's going to be a rapid recovery, in most cases, don't know. We're all making the best educated guesses. We should look at the price of stocks today and find out if they're attractive. And that's what I'm doing as an investor. Now, we can look at some of the commentary going on that's causing some of this sell-off. For example, this is Scott Bessent, the new Treasury Secretary. He recently went on CNBC to explain how the administration views this market, and he addresses some of the concerns, but some of the things he said gave investors a little bit of pause, made them a little bit concerned. This was one of them.
Back to Joe's question on working Americans, what is the American dream? But the Biden administration created this bad equilibrium where the top 10%, people in this room, probably most of the people watching this show, top 10% of Americans are 40 or 50% of consumption. And that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down. And could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period. There's going to be a detox period.
I think that
we're addicted to government spending. There's going to be a detox period. He repeats that twice. These aren't the things that the market wants to hear, but that's what we heard 3 days ago. There's also some commentary just recently from President Trump that made investors a bit more nervous. He says you can't really watch the stock market. So he says he's not paying attention to the stock market anymore, which is a dramatic change from his first term. His first term, he used the stock market as a barometer for how good his presidency was doing, how well things were going. But now he says, quote, "There's a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. It takes a little time, but I think it should be great for us." Asked whether he thinks a recession is imminent, President Trump says, "I hate to predict things like that. Look, we're going to have disruption, but we're okay with that." These aren't the most confident words on the economy, saying that there's going to be potential disruption, a time period, there's going to be some transitions. Bessent saying that there's going to be a detox period and potentially some rolling over. When you compile all of these words, they don't bring a lot of confidence to investors. So investors are becoming more defensive, becoming more conservative. You see that transition happening now. To further complicate things for investors, we have concerns of a new recession. For example, if we look at different industries and their earnings, they are flashing some warning symbols.
Good morning, Becky. Yeah, consumer spending declined for a second straight month, according to the CNBC NRF February Retail Monitor, signaling that weather and uncertainty created by tariffs and other policies out of Washington continued taking a toll in February. The Retail Monitor, powered by real credit card spending data from Affinity Solutions, shows retail spending ex-auto and gas declining by a modest 0.22% after January's sharp 1.07% decline. Taking out restaurants showed the same 0.2 decline. The year-over-year rates falling to 3.4 for the headline and 4.1 for our core index, both down compared to a month ago. It was the first back-to-back monthly decline for the monitor. We have back data going back to October 2022.
So the first month-to-month decline in consumer spending. And the data continues on showing that consumers are pulling back a little.
9 of 12 retail sectors saw declines during the month, with the largest negative in gas stations. That should be good and should help other sectors, but building and garden supplies, furniture, clothing and health, and personal care also on the decline.
2 consecutive months of lowered spending from consumers. And this is a brand new trend. At least going back a few years, we haven't seen this before. Now, this wasn't an issue in Q4 of 2024. It looked like spending was really on track, but we've only started to see warning signs of this just in the past couple of weeks. And I noticed it in one of my companies. There's one company over this past earnings season that it gave me some red flags about consumer confidence. It's a company that typically has a lot of exuberance and really fast revenue growth. A company that I know you say I talk about a lot, but it's Texas Roadhouse. I'm not trying to plug Texas Roadhouse. It just is one of the companies where I noticed they flashed a warning about consumer confidence. Now, again, this is a company that they grow revenue. That's what they do. They grow revenue every single quarter, every single year, very fast. 13% plus, way above the speed of other companies. So when I was listening to Texas Roadhouse's earnings report and reading through the transcript, we have one section of it that really stuck out to me. This is from Chris Monroe. He's the I believe, financial officer of the company. He says, "David, thanks for the question. I agree with Jerry. I definitely feel good about the business overall. Let's see if I can provide a little more context and detail on the sales trends over just the last 7 weeks. So even though they're reporting Q4, now he's talking about the most recent 7 weeks from today. So he's giving us an insight of what's going on the current quarter, Q1 of 2025, not the reporting quarter of Q4 of 2024. He says, so for the 4 weeks in January period, we were actually up 5.5%. Sales in the most recent 3 weeks were basically flat. But we certainly believe that colder weather and many other external factors this year have negatively impacted recent performance. Chris Monroe says later in this call, and these last 3 weeks have been breathtaking in terms of all the things that have come against the business. So we're still flat. So I feel pretty good about that and all of our progress this year. I view it as a little concerning about the economy that Texas Roadhouse is happy that their sales are only flat and they're not falling. They're viewing it as a win that they're able to hold sales flat currently. What does that say about other companies, ones that don't have as strong of value propositions? We also just had commentary from the CEO of Walmart that people are running low on money. Their spending is slowing down. Quote, you can see that the money runs out before the month is gone. You can see that people are buying smaller pack sizes at the end of the month. Walmart tracks their sales every single day. They have charts that show the monthly spending by every day of the month, and they're noticing the trend now that people are spending less money at the end of the month than they are at the beginning of the month. They literally are running out of money before the month's end. So these are the warning signs that are being flashed. And now we have market commentators coming out giving bigger and bigger warnings, one of them being Mike Wilson. Morgan Stanley's Mike Wilson released a note saying that the market could fall another 5%. He's talking about the S&P 500. At the rate that things are going, that could happen like tomorrow. The market's falling every minute so quickly. Bloomberg reports that the strategist, amongst other popular bearish voices on equities until mid-2024, said he expects the S&P 500 to hit a low of about 5,500. And that's going to happen in the first half of 2025. So in the first 6 months of this year, the market's going to have a lot of volatility and it's going to go down into a bear market. But then we have it recovering to 6,500 by the end of 2025. So he believes there's going to be a downturn and a nice recovery all within a year. His year-end target implies a 13% rally from current levels, although the path is likely to be volatile as the market continues to contemplate these growth risks, which could get worse before they get better. The strategist also warned that benchmarks could sink another 20% in the likelihood of a recession. We are not there yet, but things can change quickly, and so it's useful to know the downside in a bear case to manage one's risk. Now, Mike Wilson's prediction that the market tumbles another 5% and has some volatility could be true. Maybe that happens before we have a recovery. But this is market speculation and short-term predictions. They're inherently unpredictable, and it's very difficult to determine what's ultimately going to happen. And investors shouldn't be focused on this in the first place, unless you need liquidity now, in which case you shouldn't be in stocks to begin with. In most cases, we should be looking out 5 or 10 years. Warren Buffett has repeatedly said that he can't predict the stock market or the S&P 500 over the next year, even the next 2 years. But he knows with a level of confidence that 10 years from now, the S&P 500 will be higher. And I believe the same thing is true today. If we have that long-term focus, everything in the short term becomes an opportunity. Now, as I look at this, there are some stocks that I am somewhat concerned about, even over the long term based on current valuations, Apple being one of them. I've been reducing my Apple position because when I look at the combination of growth, predictability, profitability, the stock trades at a very high valuation with very slow growth. And that's a combination that's very difficult to get attractive returns from. Another issue that Apple has ran into is they're frankly just struggling with AI. This is one of the companies that probably had one of the biggest opportunities for artificial intelligence over any other company. Just consider the vast nature of Apple. They have billions of devices in people's hands, devices that can run artificial intelligence. They could integrate it directly into their AI assistant, Siri. But Apple has largely stumbled on this. Most people that use the iPhone aren't in love with the AI features. Aside from what the marketing would tell you, from what I see, almost everyone isn't too impressed with it. This is from Mark Gurman, and it's an excellent report on the struggles going on with Apple's AI. Apple, the company behind the Mac, iPhone, iPad, and other groundbreaking products, has typically beaten rivals by following the hockey approach. They skate to where the puck is going to be, rather than where it is right now. But we're currently in the middle of the biggest technology revolution since the debut of the internet, and Apple has barely even They're barely even on the ice. Welcome to the Apple crisis. The company has been scrambling to catch up to generative artificial intelligence, the technology behind ChatGPT and other cutting-edge chatbots. But its rivals only seem to be getting further ahead. And now the unveiling of Amazon.com's Alexa Plus has made Apple's shortcomings more apparent. Now, Apple's trying to get into the AI game. In fact, that's the biggest central selling point of their new phones. The entire phone upgrade cycle relies upon AI working, and working really well for Apple. The company's broader suite of AI features, Apple Intelligence, has been rolling out in stages since last October. The current capabilities include writing tools, voicemail transcription, custom-generated emojis called Genmojis, and image playground app, which can create cartoon versions of your photos and ideas. There's also auto-sorting of emails and enhancements to notifications. But these features are just nice-to-have options at best. Some of them are basically useless. And that brings us to a startling moment. One of the most innovative companies in the history of the world has at least so far flopped on AI. Now, some people say, Joseph, you're just bashing Apple because you sold the stock. No, you have that the other way around. I sold the stock because I'm seeing what's happening with it. This is the reason that I'm selling out of Apple. This is the reason that I've reduced my position, is because I'm seeing this happen. If Apple was nailing AI, if they were really just doing everything perfectly, I would still be holding the stock. My money reflects my viewpoints, but this is also Mark Gurman. He's one of the best reporters on Apple. He's not an Apple hater. He's just reporting that they're not keeping up with technology. So the people that try to come after me for saying that I'm being harsh with Apple, I'm just telling reality as it is. The AI so far in Apple has been a flop. Even Apple's attempt to integrate OpenAI's ChatGPT into its software, a bid to make up for its own failings, hasn't been executed well. The feature feels like an afterthought and lacks conversational abilities. And the visual intelligence capability, which provides users with information on items in the real world, feels more like a basic version of Google Lens. Apple's notification summaries, one of the most basic AI concepts, has been disabled for some apps after falsifyingly breaking news alerts. The notification summary is also something that I disabled on my phone after I found that it, in most ways, altered the texts to where I didn't understand them. I'd rather just see the text itself. All this undercuts the idea that Apple Intelligence will spur consumers to upgrade their devices. There is little reason for anyone to buy a new iPhone or other products just to get this software, no matter how hard Apple pushes in its marketing. So all their marketing efforts from Apple's going around AI. They've released advertisement after advertisement, Apple Intelligence, and so far the features are just underwhelming. There's no big hook. There's no big thing to make people want to upgrade. Just to give some perspective, there's another chart that I'll share here. This is one that's a recent addition to Qualtrim, but I think it's a nice chart to put in some historical context. For example, if we look at the price to earnings, we'll do the price to earnings of Apple, and we'll go back 5 years. This is what it looks like. In fact, let's go back 10 years. Let's take a bigger look at this. When we look at the price to earnings over a 10-year basis, this is what it looks like. Let's go ahead and zoom in here. That's what it looks like. Notice that the PE ratio has gone up over time. This is the trailing PE every single quarter, updated every single day. So you see the historical PE ratio way back in 2015 and 2016 being at a 10. Now, if you can believe it, this is where Warren Buffett started buying it. So he was buying Apple on the cheap at a 10 PE ratio. In some cases, he was buying it upwards of a 16 or 17. He did quite a few buys. He felt strongly about it at around these valuations. So he was buying it right here. And then he bought, a little bit more around here. And that's where he stopped buying the company. Now, again, if we look at Apple, the PE ratio spiked up in 2020. There is this huge surge of sales. Investors got really excited. It went to a 37 trailing PE. And then it went back down all the way to a 20. And now we also have Apple today at around a 35 trailing PE. Now, again, if we map that out, that means that during this time period, right around here, Apple was trading for around a 15 to 20 PE ratio. And this is during a time period where Apple had significant growth prospects. They were just ramping up all their service businesses, all their monetizable digital products. Apple is in the transition from going from a hardware company to a software company. That was around 2016 to 2019. That was a time period where I was heavily buying into Apple. Now it's trading at an even higher price of a 35 PE, but it also is reliant on this AI growth, which I believe is less predictable than the overall services growth. So that's the predicament that Apple's in, but they're not the only company that I'm concerned about. Another stock I'm concerned about is Tesla. This company's going through a sell-off already, but we could see more in the future. Tesla stock drops again, analysts see a serious sales slowdown. The drop came after UBS analyst Joseph Spack reduced his first quarter delivery target to 367,000 from 437,000 vehicles. For 2025, SPAC expects 1.7 million cars delivered, far below Wall Street consensus of about 2 million. So there's now analysts breaking. They're coming in and saying, we think that deliveries are going to be much lower than people expect. Now, we know that Elon Musk has become a talking point across Europe and other places where they don't like his politics. So his politics may be impacting, in fact, they're for sure impacting Tesla sales in certain parts of the world. But that wasn't one of the reasons that he listed out here. SPAC simply observed that Tesla's lead times, pricing, and early yearly sales data looked very weak. Tesla today is down an astounding 15.8%. This is a dramatic sell-off. And again, you can blame a lot of different reasons for this sell-off, but I ultimately believe that there is one overarching reason, and that is because of valuation. I simply think that Tesla has been overvalued for the past couple of months. I've said so many times, but those claims never come with any credibility when Tesla stock is soaring. So in days like today, we can take a look again at the valuation. If we look at what's happened with Tesla stock, the stock price, so we're looking at the stock price here, went up huge after President Trump won. The stock went from $220 all the way up to $480. This massive gain just from sentiment shift. Did anything change with the fundamentals and the numbers to justify such a price surge in such a short period of time? Not really. If we look at the revenue growth of the company, it's been flat for 2 years. So we don't have any surge in revenue growth to justify this incredible increase in price. We can also look at the cash flows. If we look at that on a trailing basis, we can see that the cash flows are down. They're down to only $3.7 billion over the trailing 12 months. That's not a lot of money for a company that was trading at $1 trillion market cap. For perspective, Google was roughly twice the market cap of Tesla and made $70 billion in free cash flow. Tesla, being half the size, made a tiny fraction of the same amount of money. So this price increase, all this sentiment change in Tesla was driven purely by optics and sentiment. There were no fundamentals behind these changes. When you look at the valuation of the company over the past year, we can look at the price to earnings or the price to sales. They paint the exact same picture. Either way, Tesla just simply got a lot more expensive from September and October of 2024 to January of 2025. The stock price just went up without the fundamentals changing at all. And this is where a lot of investors looked at the stock price increasing and they say, Joseph, I told you so. I told you Tesla was a great stock. It's a great company. The stock price has gone up. They use that as evidence of the stock doing well. But all of this was reliant on sentiment and multiples increasing. The fundamentals of Tesla have not changed that much over the past 6 months. And that's the problem with the stock. As investors, we shouldn't be anchored to stock price fluctuations and changes in sentiment. We should be anchored to the fundamentals of the company. With Tesla, what would be a big told you so moment? What would prove Tesla investors right is the cash flows increasing dramatically, the revenue growing dramatically, the free cash flow going from $4 billion to $10 billion to $20 to $40 billion. That would rationalize and justify a stock price movement like we've seen. But so far, we don't see that in the numbers. So Tesla's a company that I'm still concerned about as a stock that many investors are investing in this one based on sentiment and commentary. And unless the fundamentals change, this is going to be a painful stock and continue to be a painful one for a long period of time. Tesla investors have seen no gains since 2020. The stock has floundered around the same price over the past 4.5 years. Another stock that's down big today, down 11% and down 40% from its highs, so it's been nearly cut in half from the highs, is Palantir. Now, normally when a stock is down 40% from the highs, you can look at it as a great buying opportunity. Palantir was just recently at $124 per share. Now it's traded all the way down to $75. So when something goes from $120, $140 down to $75, you think buying opportunity. But this is another one that I would caution investors about jumping into without looking at the valuation, the historical trading, or what's currently priced into the stock. Now, I've recently gone over my expectations of growth for Palantir and taken a look at the big assumptions you have to make. But when we look at Palantir through a historical price to earnings, or price to sales, which is commonly used for tech companies, I'm going to draw two lines on this chart. The first one is the line of Palantir's current price to sales. It's above 60. It's around 64 price to sales. So this is where Palantir is trading on a revenue multiple right now, at a 64 times revenue multiple. Now, if we compare this against the average of this industry, where typical companies trade that are fast-growing, technology-driven companies with huge markets and huge scalability, this is where they typically trade. I'll throw in a gray line to show where they typically trade. That is where the majority of companies, in fact, almost all of them trade except for Palantir. Right around there at a 25 multiple on revenue. Now, don't be fooled here. That black line is still in the expensive category. In fact, I made a rule for myself that I'd never buy a company trading above a 20 price to sales, because in so many cases, those companies turn out to be devastating losers. When you buy companies with that type of expectations of growth baked into the stock price, it's already very demanding. And you consider that Palantir trades at 3 times the multiple of many other great companies like CrowdStrike that are growing equally as fast. So this is another one that, even though it's come down a lot, it's selling down, it's one that I would caution against racing into. At least know what you're getting into and the expectations you have to have for this company to work out. Now that's all for now. I'll have more episodes out on what I'm buying and different companies I'm looking into. So if you like this type of content, make sure to subscribe to the channel, hit the thumbs up button. See you in the next one.